On December 11, 2008, FBI agents walked into the Manhattan apartment of a 70-year-old man who had just confessed to running the largest financial fraud in history. His name was Bernie Madoff, and he'd stolen $64.8 billion. Not million, billion, with a B. And somehow nobody noticed for nearly 2 decades. But Madoff wasn't alone in the art of making money disappear. He was just the loudest. Behind him sits a lineup of financial scammers so bold, so creative, and so spectacularly reckless that you'd think they were competing for some kind of award. We're talking about 6 scams that collectively destroyed over $200 billion in value and left regulators around the world wondering what exactly they'd been doing all those years. Spoiler: the only thing these people won was a prison sentence, or in some cases, an Interpol warrant. To understand how these scams worked, you have to understand one thing. People trust numbers. Show someone a spreadsheet with consistent 10% returns and they'll hand you their life savings, no questions asked. It's like handing your car keys to a stranger because they were wearing a valet uniform. At the time, the financial world ran on reputation, handshakes, and a stunning lack of curiosity about where the money was actually going. Remember when your parents told you not to take candy from strangers? Wall Street apparently skipped that lesson. Bernie Madoff knew this better than anyone. By the early 1990s, his investment firm was managing billions for wealthy clients, hedge funds, and even charities. His strategy was supposedly brilliant but secretive. He served as chairman of the Nasdaq Stock Exchange, which gave him the kind of credibility that most fraudsters only dream about. Investors didn't ask too many questions because the returns were steady year after year, hovering around 10 to 12% like clockwork. Even when markets crashed in 2000 and again in 2007, Madoff's clients somehow made money. Wall Street analysts were impressed. Some were suspicious. A financial analyst named Harry Markopoulos literally wrote a report titled, "The World's Largest Hedge Fund is a Fraud," and sent it to the SEC. Nobody did anything about it. The plan was simple enough. Madoff wasn't investing anything. He was running a classic Ponzi scheme, using new investors' money to pay old investors' returns. Think of it like a group chat where everyone thinks they're getting paid, but the money's just going in circles. As long as new money kept flowing in, nobody noticed the tank was empty. "I thought it would be over in a week," Madoff reportedly told investigators after his arrest. It lasted 17 years. Meanwhile, on the other side of the world, a German company called Wirecard was pulling off something even more audacious. Founded in 1999 as a payment processing company, Wirecard climbed its way onto Germany's prestigious DAX 30 stock index by 2018, replacing the 148-year-old Commerzbank. Its CEO, Markus Braun, insisted the company was the future of fintech. Executives believed they were building the next PayPal. Investors poured in $28 billion in market value. The problem? About $2.1 billion of the cash on their books didn't exist. Not misplaced, not in a different account, just fictional. Like writing $1 million on a napkin and calling it a bank statement. The Financial Times started publishing investigative reports questioning Wirecard's numbers as early as 2015. Germany's regulator BaFin responded by investigating the journalists instead of the company. Imagine calling the fire department and having them arrest you for pulling the alarm. Then there was WorldCom, once America's second-largest long-distance phone company. In the late 1990s, CEO Bernie Ebbers turned WorldCom into a telecom giant through 65 acquisitions worth $77 billion. At its peak, the company was worth $175 billion and carried 50% of America's internet traffic. Ebbers believed bigger always meant better. Behind the scenes, CFO Scott Sullivan was hiding $3.8 billion in expenses by recording them as capital investments. It was the financial equivalent of maxing out your credit card and calling it a business loan. Meanwhile, AT&T and Verizon were playing it straight, building actual infrastructure and reporting actual numbers. Boring? Yes. Fraudulent? No. At first, nothing seemed wrong with any of these companies. Markets were booming, regulators were napping, and auditors were apparently on permanent vacation. Confidence was high, suspicion was low. Then the cracks started to show, and when they didn't just crack, they shattered. Luckin Coffee was supposed to be China's answer to Starbucks. Founded in 2017, the company opened stores at a pace that made Silicon Valley startups look lazy. By 2019, it had over 4,500 locations across China, raised $561 million in its IPO on the Nasdaq, and was burning through cash like it was kindling. The growth looked incredible on paper. Turns out that's because most of it only existed on paper. In early 2020, a short seller called Muddy Waters published a damning report, and an internal investigation soon confirmed the worst. Luckin had fabricated roughly $310 million in sales over just 3 quarters. Employees were literally manufacturing fake receipts and inflating transaction counts. It was like a lemonade stand lying about selling 10,000 cups when the neighborhood only has 12 houses. Meanwhile, Starbucks was doing the boring thing, actually selling coffee and reporting real numbers. Then came FTX, the crypto exchange that made all previous financial scams look almost quaint. Sam Bankman-Fried, a 30-year-old MIT grad in cargo shorts and a messy mop of hair, built a $32 billion empire that made him the poster child of crypto legitimacy. He appeared on magazine covers, testified before Congress, and donated $40 million to political campaigns in 2022 alone. "I want to make crypto safe for everyone," he told interviewers with a straight face. Behind the scenes, FTX was allegedly funneling billions in customer deposits to Alameda Research, his own trading firm, which was making enormous, risky bets with other people's money. It was like your bank lending your savings to their cousin's gambling habit and hoping nobody would check the balance. By November 2022, after a devastating Twitter feud with Binance, CEO Changpeng Zhao triggered a bank run, FTX filed for bankruptcy. $8 billion in customer funds had evaporated overnight. Think Breaking Bad, except instead of meth, it was math. And instead of a trailer in the desert, it was a penthouse in the Bahamas. Greensill Capital, based in the UK, was supposed to revolutionize supply chain finance. Founded by Australian-born financier Lex Greensill in 2011, the company made loans to businesses based on future invoices, essentially lending against money that hadn't been earned yet. The concept itself wasn't new, but Greensill scaled it to absurd proportions. By 2019, it managed over $143 billion in financing and counted SoftBank as a major investor. Credit Suisse packaged Greensill's loans into investment funds and sold them to clients as safe, boring returns. But there was one problem. Many of Greensill's biggest clients were either financially shaky or, in some cases, didn't even have real invoices backing the loans. The company was essentially lending against "I owe us" from companies that might never pay. When insurers pulled their coverage in early 2021, the whole house of cards collapsed. Greensill filed for insolvency in March 2021, and Credit Suisse froze $10 billion in funds tied to the company. It's like discovering your insurance company was actually just 2 guys in a trench coat. The aftermath of each of these scams reads like a disaster movie marathon. Madoff was sentenced to 150 years in prison in June 2009, the maximum possible. He died behind bars in April 2021 at the age of 82. His investors lost an estimated $17.5 billion in actual cash, and the ripple effects destroyed charities, pension funds, and family fortunes. Wirecard's Marcus Braun was arrested in June 2020, and the company's stock dropped from over €100 to under €2 in a matter of days, wiping out billions in shareholder value. COO John Marsalek, the alleged mastermind of the fraud, vanished entirely and reportedly fled to Russia. Germany's financial regulator BaFin was so embarrassed that it was eventually restructured from the ground up. Guess it's hard to regulate what you refuse to look at. WorldCom filed the largest bankruptcy in U.S. history at the time in July 2002, with $107 billion in assets. 20,000 employees lost their jobs. Bernie Ebbers got 25 years. Scott Sullivan, who cooperated with prosecutors, got 5. Luckin Coffee was delisted from the NASDAQ in June 2020, just 13 months after its IPO, and paid $180 million in SEC fines. Sam Bankman-Fried was convicted on 7 federal charges in November 2023 and sentenced to 25 years in federal prison. He went from Forbes billionaire to federal inmate in roughly a year, from penthouses to prison cells. And Greensill? Lex Greensill walked away without criminal charges, though investigations in multiple countries continue. Credit Suisse, already weakened by the scandal and the Archegos collapse, eventually fell apart entirely and was absorbed by UBS in June 2023 in a government-brokered emergency deal. $17 billion in bondholder value disappeared overnight. Turns out, when your investment strategy depends on trusting a single company with imaginary invoices, things tend to go sideways. All from the same basic mistake. Nobody checked the receipts. Every one of these disasters shares a common DNA. Someone with authority said, "Trust me," and everyone did. Regulators looked the other way, auditors signed off without digging, and investors were too distracted by returns to ask where the money was actually coming from. It's the financial version of that meme where the dog sits in a burning room and says, "This is fine." If Madoff's early investors had demanded independent audits, if Germany's BaFin had taken the Financial Times Wirecard reporting seriously back in 2015, if WorldCom's board had questioned why billions in expenses kept vanishing from the books, if anyone at Luckin had said, "Maybe we shouldn't invent sales numbers," if FTX had kept customer funds in an actual customer account instead of a hedge fund's trading desk, if Credit Suisse had spent 5 minutes Googling Greensill's clients, hundreds of billions would still be in people's bank accounts. Careers would still be intact. Retirement funds would still exist. But they didn't check. Nobody checked. And here we are, making YouTube videos about it. Some lessons apparently need to be taught more than once.